Oh, sweet. All right. Welcome to the Microstructure Exchange. I'm happy to have everyone here from wherever it is that they are. Today we have Robert Battalio with us, and he's going to be presenting two papers, and I'll let him get into that. But just before we dive into it, I wanted to remind everyone that the call for papers expires on Friday night, I believe, Eastern time. Josh, thanks for putting that link in the chat. I can't think of any other announcements. Robert's going to go for 45 minutes. We'll do Q&A kind of peppered throughout, but like a focused Q&A for the last 15 minutes. And if the Q&A spills over past the top of the hour, then Robert has agreed to stay on for a few minutes to kind of meet people's questions. Okay, I think that's all that I have. Robert, why don't you take it away?
All right, thanks a lot for inviting me to present today. So mostly this is going to be some early work with Bob Jennings and Mehmet Saglam, who's on both those guys on the call. I don't know if Jun is or not, but he's an IU alum as well. And so really the goal of the presentation is going to be to think about the ability of the Ballmer-Jones algorithm to identify retail trades, false positives. How often does it get it right? How often does it get it wrong? And kind of like on the way to doing that, I want to give a pretty in-depth, quick description of what retail order flow looks like today. And that's why the other paper is attached. We do a pretty detailed description of May 2022 data from a wholesaler or one or more wholesalers. So the algorithm, most of the people on this call, I don't think have to explain, purports to be able to use publicly available data to identify retail trades. And if successful, then that's a fantastic algorithm and very useful. And you can kind of see this morning, the Web of Science cites 41 and Google cites 246 and several top tier papers that have already been published using the algorithm. So it's taken off. I think most people here know what the algorithm does, but just in case, the algorithm assumes that all retail order flow goes to wholesalers. Who are wholesalers? Citadel, Virtu, Jane Street, G1X, and that all of these guys trade against the customer orders and report the trades to the FINRA TRF. And more than just report it to TRF, because of regulators and because of competition, the wholesalers give sub-penny price improvement. Okay, so the idea is all the retail flow goes to wholesalers. The wholesaler is going to improve the price just a little bit, and they're going to all report it to the TRF. Okay, so to separate so institutional trades also, so about 40% of the trades or volume are executed in the dark or on the TRF. Half of those institutional, half of those retail. To separate these two sets of trades, the algorithm relies on the logic that only the retail trades are going to print at a sub penny of like 0.001 or 0.002. And when you see an institutional trade, it's going to be at the midpoint. Okay, so these are assertions made in the paper. And they assert their approach is therefore likely to pick up a majority of overall retail trading activity and avoid institutional trading activity. So as I kind of mentioned earlier, what I want to do is just describe retail order flow circa 2022. Bob and I had data 20 years ago, and it looks way different today than it did back in the day. In a companion paper we'll post, we use publicly available data to show that in May of 20, so I was not fully aware that independent of whether you take payment for order flow or not, you're routing your order flow to a wholesaler. And so in the I'm not going to discuss that today for time, but if you look at the 606 filings from May of 2022, the brokers who don't accept payment or don't charge for the order flow are sending their orders to the same places as the people who sell order flow. So in fact, the assumption made in the Jones paper that everything's going to a wholesaler seems to be pretty accurate. So we obtain proprietary order data from one or more wholesalers to kind of understand the type of orders they're getting. And when the wholesaler gets the orders, are they truly executing all of them in the dark, or do they put some to exchanges? I'll describe a little bit of that today. I'll also present a little bit of evidence that suggests that the clientele of retail brokers is a little bit different than it used to be back in the day, or at least what I viewed it was back in the day. Certainly a few of these guys are appealing to institutions. So in the companion paper, I think we present overwhelming evidence that justifies the routing of marketable orders to wholesalers. So it turns out Dieberg, Shipkilko, and Ingrid have a paper a little bit similar to ours. We use 605 data to kind of examine, can you justify why it is these brokers are routing everything to wholesalers, and the data allow you to do that. We just do a month. Those guys do a time series and basically say that if wholesalers save retail investors billions of dollars, quote from their paper. So what we do is just note that even the 605 data don't allow you to take apple and apple comparisons because the market conditions are different when exchanges receive orders and when wholesalers. And so in the paper that we'll post, we do a near neighbor comparison, which is almost like a horse race, and we look at orders simultaneously routed to the wholesaler and to an exchange. And that evidence, again, suggests that it fully supports the decision to kind of route marketable orders to wholesalers. Then, so it turns out, for reasons I'm not 100% in my mind aware, we have data from May of 2022. That's what's going to be described and used in the one paper. And then to examine the Ballmer-Jones algorithm, we're going to get the same data, but from December 2020. Okay, and you just have, so it's the same type of data. I'm not going to go into, so the paper, the execution quality paper does a very nice job of deeply describing the data. And so that's why we're going to appeal to those statistics in today's talk. And so I should say that we're going to ultimately match the retail trades in December 2020 to trades on the ADF. I'll describe a little bit of that more later, and look to see, how often is the algorithm correctly identifying a retail trade? What I want to say here is, to be clear, we're not the first to do this. Barber and Schwartz and Odine and a couple other people, Jorian, and I forget the other one, they place $100 orders in a random set of, in a selection of stocks, and they've got an execution quality paper out there, but they also have a paper that looks to see how well does the algorithm do at picking up the retail trades, and they'll find things similar to us. We're going to find about 3 out of 10. The difference between us and them, at least on that part of the analysis, is we have all the orders routed to one or more wholesalers in a month, not just some actual orders. And their sample has about 20% of trades in penny spread markets, and at least for the distribution of orders that we obtain in December, it's 40% in penny spread markets. So there's a little bit of differences, but certainly that flavor, we can certainly expand what they did with their sample. I think what's more novel is we're going to use 3 data sets of institutional trades in the dark to examine the possibility that the Ballmer-Jones algorithm is going to incorrectly identify institutional trades in the dark as retail. So with Mehmet, we have data from 2011-12, VWAP order child executions in the dark. We're going to use data provided by the wholesalers for December 2021. And then we're also Colorado Public Employee Retirement Association, COPERIS trades. We have those for 2016 and 17. And so we'll show you what their trades in the dark look like with regard to sub-penny executions. And then if I have time, we'll present correlations between the order imbalance used, computed using the wholesalers trades for 2.5 years, and the Ballmer-Jones inferred order imbalance over the same time period. And we'll admit that we have more to do. Okay. So again, I think everybody here is aware that when a marketable order gets placed with a broker, the broker can either route it to an exchange and pay a liquidity fee, or if a wholesaler will accept the order, they can route it to a wholesaler and can either get a payment or not charged. Okay, and so this is the economics. Again, in this audience, probably don't need to show this slide. Not sure if everybody is aware of this. The wholesalers, Citadel, Susquehanna, G1X, they're getting almost no non-marketable orders, right? So the only non-marketable orders those guys get, in my belief, is an order is marketable. Limit order, when it comes in, market moves away, it becomes non-marketable, stays on the wholesaler's books. Okay. Otherwise, you can look at the 605 reports, and brokers are either routing directly their non-marketable limit orders directly to an exchange, or to get the volume discounts written about by Chester and his co-authors, they route it to the wholesaler, who then uses the no knowledge exception to keep the order off of its book and route it to the exchanges and then pass back the fee. So there's a total bifurcation: marketable going to the wholesalers, non-marketable to exchanges. All right, so why do retail brokers who do not charge for marketable orders route them to the wholesalers? One is to avoid the fees, and then the question we ask in the one paper is whether or not it's to enhance execution quality. Can you justify that? So I described this a bit. We obtained all of the retail order flow sent to one or more wholesalers in both May and December. When we start to look at the ability of the Jones algorithm to correctly identify retail trades, we have to admit, a lot of us were teaching, not Bob, but the rest of us. So we just look at 10 days in December. We'll expand that out in January and February, but my guess is that'll hold. 2021, we get all of the wholesalers' trades against institutional child orders in the dark. Now, they didn't provide us with midpoint trades. Again, we told them we would like to demonstrate the ability, whether or not the algorithm is picking up false positives. So they knew that the algorithm would not call midpoint trades retail. So my guess is that's why we didn't get those. So we've got sub penny, but not at the half penny, and there's 2.1 million in December 2021. Well, so in their paper, Belmer Jones say that, gee, maybe there's some institutional trades printed not at the half, maybe printed on the sub penny in the early part of the last decade. We have trades from the early part of the last decade, and we'll show that that's kind of true. And then just for another sample of trades, the pension fund dark trades in 2016 and 17. And then finally, we'll get all the trades reported to the TRF in December 2020 and match that to the retail trades. So that's kind of what's going on in the background. All right. So descriptive statistics of retail trades in May of 2020. What kind of was amazing to us was that, there's 266 marketable orders seeking to trade more than 10,000 shares. That's about 0.5% of the orders and a lot more of the trades. And so if you think about the trades that are, and why would you do this? Well, in the paper, I won't talk much about it. The wholesalers basically tell the brokers that, gee, we'll guarantee you the order receipt time quote. Right. And so, gee, if I'm seeking to trade a lot more shares than are available to inside quote, that guarantee is nice. Right. And so to the extent the wholesaler is able to do that, you can see why maybe institutions might want to place some of these larger orders with their brokers. So this just shows you that. And then so I did some digging. We found on Ameritrade's webpage, they actually advertise for institutions to trade, and they point out that you can trade with zero commission. And if you look at their 606 routing, they're routing them to the wholesalers. Okay, so I think when we say that we've got, even we say we have all retail trades, yeah, we have all trades placed with brokers we refer to as retail brokers, right? But the characteristics of who the clientele is, right, may vary across brokers. All right, so for those of us in microstructure, so there's an old paper by Peterson and Siri, which I love, and it basically shows why you might want to place a marketable limit order, because you're worried that the price is going to move before you get there and you want to reduce execution price risk. Notice that the brokers who route orders to the wholesalers, 70% of the orders are market orders, which to me tells you that the brokers are not worried about trying to force their customers to reduce execution price risk by placing a marketable limit order. They're, so the market order is easy. You push a buy, sell, boom, right? And if it comes back with a positive experience, meaning trading either at the MBBO or within, everybody's kind of a winner. So this statistic on this slide, I think, kind of points to the fact that the wholesalers are offering more depth than maybe we would think, or certainly offering executions at or within the MBBO. And then finally, so this slide, why is this important? You'll see that 87% of the orders are fully internalized. So what that means is 87% of the marketable orders sent to the wholesalers are going to be internalized and reported to the ADF. Okay. And that would be 58% of the trades. But externalized orders are going to be the orders that come in and the wholesaler, for reasons, maybe position limits, risk appetite, regulatory considerations, or occasionally. So what we've learned, and Tom he's here today, he tells me that you can tell when there's going to be a midpoint execution on the IEX, and that was confirmed by the people who provided us with the data. So certainly the wholesalers will source external liquidity when they think, and every time they can get a midpoint execution, it's money not coming out of their pocket to give price improvement. And so you can see that the externalized orders are 11%, but it's 19% of the trades. Now, we were not allowed to kind of see where those go. Some of that's going to exchanges, some of that's going to other wholesalers, perhaps dark pools, right? We just know that some of it is going to end up on exchanges, but how much can't say. And then the partially internalized, the wholesaler will execute one or more pieces of a big order and then source liquidity elsewhere. Okay, so that's kind of a description of where trades and orders get executed. They get routed to the wholesalers. Right. Now, the externalized orders, that's the bottom in the blue. You can see they are getting sub-penny price improvement on average, meaning some people would call this de minimis price improvement. Okay, let's see. Not a question. So Sunil says the block test to TD Schwab is enormous and regularly prints blocks to the tape. This order flow from RIAs that is retail, but is coming from RIA. These orders are almost always reported inside the quote, but often not always at some penny. So Sunil would know because he has the data to answer that question. But so anyway, that's in the chat. So what you'll see though in panel A is the fully internalized orders are getting more than 1/10, 2/10, 3/10, and 4/10 price improvement, right? On average, they're getting 8/10. And in a penny spread market, that 8/10 is going to put you above the midpoint and cause the algorithm to maybe misclassify you as a buy rather than a sell. So you can see that the price improvement's not de minimis on the fully internalized orders on average, at least. And why do I say bigger than 0.004? Because between 0.004 and 0.006, that price improvement's labeled institutional. And then so it's just between the 1/10, the 4/10 roughly, and the 6/10 to 9/10. All right. So now we'll move in to the other paper, but I just want to summarize what we show in our paper. And again, Andre and his co-authors do this on a much, so they do some of this with regard to the 605 stuff on a bigger basis, right? And they seek to answer a different question than we do in our paper. We wanted to know, why do brokers who do not accept order payments route to wholesalers? And so that's kind of the motivation for our paper. And so one thing that's interesting is the SEC mandates the production of execution quality statistics for a set of orders, and that set of orders does not include odd lots, and the set of orders does not include short sales. Okay, so what we do is we quantify the amount of savings for investors in May of 2022 that are measured by the SEC's 605 reporting. That's 78 million. If you expand kind of the SEC's methodology to the other sets of orders, short sales, odd lots, you'll see the number gets bigger. And then if you assign a value to trades in excess of the posted depth, that number gets bigger. Ignore the trades in excess of the posted depth, but just think about the odd lots and short sales. You know, if brokers didn't care about their clients, why would you worry about getting price improvement on stuff that's not measured? Right. So what's interesting, at least to us, it suggests that there is competition, that brokers do care about execution quality about more than is measured and publicly displayed. I should say Jeff and I and Bob kind of have a paper that did this. Can you place a value on the amount of price improvement relative to what you get if you walk the book? And so this is just an updated kind of version of that. And then we do the nice near neighbor analysis that kind of attempts to really hold market conditions constant. And so all in the paper, we feel like given today's market structure, it seems like it's the correct decision to route to wholesalers if you care about execution quality. All right. So that describes kind of the date. Go ahead.
Oh, sorry. I didn't mean to interrupt. Sorry. But I was wondering if we had people who had questions before we kind of move on to the next part of the talk here. If anyone has a question, you can feel free to jump in. But if not, we can proceed. All right. Okay. Go ahead, Robert.
All right.
Oh wait, hold on. We got some questions from Yashar in here. So Yashar, do you mind if I read these for you?
All right. So 2 questions. What is the conditional probability for retail trade to be actually? We're going to talk about that now. And then externalize the same as riskless principal. The answer to that is no. What on the riskless principal thing? What's interesting, and we talk about this in the paper, and I had no idea this was happening. It's often the case that when the wholesalers source liquidity out from an exchange or somewhere else, the trade will be executed outside the MBBO. Okay. What the wholesalers will do is they'll print another trade on the ADF so that they can give the customer a better price. And so if that's what you mean by riskless principal, they'll get the liquidity on an exchange, and then they'll unwind the trade against the customer, but at a better price in the dark. So I don't think that's exactly riskless principal, but they will cover and then improve the price. And they do. So if you measure the price improvement of externalized trades, it's actually negative. If you don't consider what the wholesalers do as far as unwinding the trade and giving a better price, if you count that, the externalized trades actually get price improvement. So it kind of tells you, again, that the wholesalers are being held into account for the MBBO for all orders, not just the ones they internalize. And so they are actually spending money to improve the prices of the orders that trade outside the MBBO on an exchange.
So thanks, Bob. Just to clarify, so what I'm basically thinking about is whether with externalized trades, the wholesalers are carrying inventory to the extent that they would carry inventory if they internalize.
Okay, I don't understand the question.
So with the riskless principal, they're essentially posting a proprietary order on some other exchange, or sorry, other trading venue. And if that fails, they're going to fill the customer order.
Okay, no. So this is just marketable, and they'll go get the trade. They'll take, and then often they'll improve the price by unwinding the trade against the customer. So they're not passively, they're not passively anticipating any of that.
Okay, got it.
At least as far as we can measure. Now, I'll be real honest with you. We have guardrails with what we can and can't do. We didn't build inventory positions or anything else like that. Right. But okay.
Great, thanks.
All right.
Hey, Bob, can I ask the question?
Yep.
Yes, this is Greg Eaton. I was wondering if you all observed the limit order data, and if you have any sense of what percentage of retail trade is limit order versus marketable.
So you can look at the 606 to get the percentage of limit versus market. What I'll say is there's an underutilized, well, it's a database that Bob and I couldn't figure out how to correctly utilize, but there, you can get data from Direct Edge Stock Exchange that will actually tell you which limit orders were submitted. So they have a retail attribution program where if you have the direct feed from EdgeX, I can, as Ameritrade, choose to have Ameritrade sitting next to the limit order as it's displayed. And so to the extent you care about, so 2017, 18 is when we had the data, if I remember right, and you can get a nice view of like E-Trade, Ameritrade, and a couple of other brokers, the limit orders they send to Direct Edge. But otherwise, no. And again, I think the other answer to that is the wholesalers wouldn't have that data, or else it'd be violating the no knowledge exception, right? So part of that says they can't see it. It just has to kind of go around them, because as soon as they see it, it has to sit on their book, and then all of a sudden it's competing to interact with the purchased order flow. Good. Okay. All right. So going forward, we have 10 days, December 2020, that we're going to match the retail data to TRF data, and then we're going to type it using the Jones algorithm and test some things. We're going to get institution versus wholesaler dark trades, December 2021. We have institutional VWAP trades from 2011, 2012, and then finally Copera data, which was obtained under Freedom of Information Act. All right. So we're going to restrict our sample to stock symbols with at least 100 round lot trades per day, and end of month price that exceeds $1. We'll end up with 2,700 sample stocks that account for about 85% of the trades. As I mentioned, for now, first 10 days, we'll expand that. We use the Bummer-Jones Zhang method to infer which of the TAC match trades came from retail investors. We'll see how well the algorithm does at correctly identifying retail trades on the next slide. So the second row there, 0, 0 to 0.10, that's tenths of a penny. So trade prices that end not on the figure, but with prices 0.0001 to 0.1, right? So the mod, this is their description. What you'll see is 21% of the buy orders and 18% of the sell orders trade on round pennies. 17% of the buy orders and 12% of the sell orders trade at the around the midpoint. And so if you add things up, you get about 30.7% of the trades being correctly identified. Of the trades we match the ADF, and I should go back and say that we matched 78% of the trades with 81% of the volume to TAC. And it's not surprising we didn't match 100 of the trades, 100% of the trades, since some of those are going to exchanges. We just don't know. Yeah. The other thing, we use the participant timestamp in TAC to match to the order timestamp. And so Pete asked a question last week, why aren't those, I believe it was Pete, why those timestamps aren't exact, and it has to do with latency from the time. So the participant timestamp is the timestamp as seen by the SIP, I believe is true, and Tom and Chester on the call, they can correct me. And then the wholesaler timestamp, trade timestamp, is from when it leaves the wholesaler. So that's why there's some latency. Okay. All right, so back here, the algorithm correctly identifies about 31% of the retail trades. And this is roughly what Schwartz et al. Find with their 100 share orders. You can see the algorithm does a bit better for trades executed in penny spread markets, 19 plus 14. All right, so maybe what's more interesting. So if you look at the quotes of the papers that have been published in nice journals that use the algorithm, say, look, we know we're not picking up every retail trade. We think we're getting a nice sample of retail trades, but we're pretty, as long as we're not picking up institution child orders, we're fine, right? So the first sample I want to show you is 2,100 trades, wholesaler versus institutional child in the dark of 2020-21. How important is this? Again, you have to, here at Notre Dame, I just look up to see the crucifix. We just have to have faith in the data provider telling me truthfully. So these trades are 10% of the wholesaler's institutional trade. So if you take that as given, if you also take Rosenblatt Securities estimate that 20% of the equity volumes in the darks generated by institutions, then you could argue 2% of equity market volume involves institutional child trades that could be falsely identified as retail by the algorithm. Okay. Now, I'll be honest, a little bit later, I'm going to show you that maybe these data aren't going to be as representative as, I'll show you some samples that suggest maybe this is not representative of everything in the dark. But for now, what you'll see, about 92% of the trades that have sub-penny pricing, but not at the midpoint in December of 2021, would be incorrectly identified as retail by the algorithm. Okay, so at least for trades involving, and we'll see this in some of the other data I show you, for trades involving electronic liquidity providers, maybe it's not so rare to see sub-penny pricing, right? All right. So Mehmet obtained institutional VWAP data from a major investment bank. What's nice about the VWAP is that you know kind of the order submission strategy is the same, roughly for all the orders in his sample. And we have all of those VWAP orders. And so what Mehmet did was kind of identify the child executions. We have about 166,000 trades that the investment bank, the data provider, traded in its own dark pool. And then we have 136,000 trades where the liquidity provider sourced liquidity from wholesalers like GetGo, Citadel, Knight, okay, the precursor of Virtu. So what you see here is trades executed in the investment bank's own dark pool, about 33% would be falsely identified. So here you see a lot more trades at the midpoint for the trades executed in the investment bank's dark pool. And consistent kind of with the institutional trades versus the wholesaler, if you look at the last column, you'll see a large percentage of those trades, what, 78% of those trades would be have sub-penny pricing that would allow them to be falsely identified as retail using the algorithm. Okay. All right, one more. So Copera, Copera produced some order blotters where you have their big orders, and the data is described in my paper with Mehmet and Brian Hatch, but they have some big orders, and they give them to different brokers like JP Morgan, Goldman, etc. And then what's nice about the data set, it tells you where Goldman or JP Morgan executed the pieces of the big order, what exchanges and where in the dark. And so what Mehmet did here was he looked to see, okay, if a trade, if JP Morgan executed a piece of an institutional order in its dark pool, it would be in the table on the upper left-hand side. All brokers own dark pool trades. If JP Morgan sourced Citadel, it would be in the top right. If JP Morgan sourced Barclays LX or Goldman Sachs dark pool, would be in the bottom. Okay. So what you'll see here is, I think what struck me, if you look at the first column, that looks a lot closer to what is described. And Pete brought this point up also. He goes, some dark pools probably operate as is described in the Boehmer Jones paper. And if you look at the very bottom, it looks like the dark pools that were sourced that were not. So if I'm JP Morgan, I source somebody else's dark pool, it looks like, gee, either I traded on the penny or at the midpoint. That's the bottom, right? So it does look like there's heterogeneity. If you, again, look up in the upper right against the ELP trade, you'll see again, you see more use of sub-penny prices by the electronic liquidity providers. So there's heterogeneity. Could we convincingly show all potential for false positives? No. So we have 3 different data sets we're going to put forth to kind of suggest that there's possibility for the algorithm to falsely identify retail child trades as, institutional child trades as retail. And then we're going to move on. Okay. Where we're going to move on, and this is where we're going to fall off a cliff kind of quick. I'll show you some early results on the order and balance stuff. That's kind of work in progress beyond where we'll stop today. And then I'll throw out a few other things and maybe we'll finish a few minutes early and take questions. So what's interesting, if you read the Bomer-Jones paper, they say if you take their order and balance measure from public data and you correlate that with trades provided by NASDAQ that are retail, is my presumption, and known order side, the correlation is going to be 0.7. Okay. So first off, remember that there's 13, 14 exchanges. It's not clear what you get when you're going to test the market order imbalance versus what's happening on NASDAQ, a venue that's probably only getting retail marketable trades when nobody else wants them. Yes, because they're a high fee venue. There's some sample selection bias going on there. And they find that if they correlate the inferred order imbalance with what is known to be true on NASDAQ, the correlation is 0.7, which makes you feel kind of good, right? So in order to assess whether this high correlation persists in our data, we compute each of the 4 imbalance measures using the inferred retail trades. And then the data provider does it for the entirety of the retail order data with known order side on a daily basis. So we have a 104-week sample period from August of 2020 to July of 2022. And overall, the correlations between it, let me back up a second. So the wholesaler data, I don't know, most people on the call probably know that when a broker, so brokers aren't going to source liquidity from just one wholesaler. They're going to use 2, 3, 4. You can look at the 606 reports. They're going to use a wheel. Okay, so I think it's reasonable to assume that when we get order flow from all the order flow from one or more wholesalers for a month, it's going to be a representative sample because of the way orders are routed across the competing wholesalers. So when we compute, let me see. Somebody. All right. Hans, I'll read that a little bit later in just a second. All right. So overall, the correlations between what is the wholesaler's order imbalance and the inferred is no higher than 0.35, so half of what's documented in the Bomer-Jones paper. And so that's what this shows. Okay. So at this point, we plan to have weekly regressions, daily regressions, kind of looking to see how well the order imbalance is inferred and actual predict going forward. We're going to come up with a few other tests to try to expand the breadth of the paper. Right now, we think we have a plan. One of the things we'll do is look to see whether the proprietary trades identified by the algorithm leave the same footprint in the data as the proprietary trades that are not identified by the algorithm. So if I was going to ask you to take something away from our talk, all brokers who can, virtually all brokers who can, route orders to wholesalers. Okay, now wholesalers won't take everybody's orders, so that's why I said who can. I think in the one paper that will be posted and in Andre's paper, you'll see that relative to exchanges, wholesalers offer superior execution quality. And again, we're talking about marketable order flow. The clientele of retail brokers today is likely a little different than it was 20 years ago. Wholesalers provide more than de minimis price improvement. And again, it was the de minimis price improvement that was an assumption kind of used by the algorithm to identify retail. So again, consistent with I believe this number is really close to what Schwartz et al. Get, or Barber, O'Dane, Schwartz, Jorin, and somebody else. I apologize. I think that's close. This ignores the fact that we can't match over 20% of the retail trades to dark trades. So if you included that, maybe that number gets smaller. The assertion that institutional child orders executed away from exchange that are executed at the midpoint of the MBBO is patently false. The question is, to what extent is that false? Some are. What we plan to do kind of in the next few months is to try to come up with different ways of examining the types of biases that get introduced by that. Thanks for letting us present early work to you guys today. And thanks for the organizers for doing this. It's a great service to the microstructure profession.
Awesome. Thank you very much, Robert. So I think at this point, we'll kind of open it up for Q&A. I see there's a couple of comments, like maybe those are worth discussing if the posters of those would like to do so. But in general, for the Q&A, if you hit the little raise hand button, I'll cue you up. Sunil, it looks like you're up first.
Hey Rob.
Morning.
Good morning. Very nice paper. I really do like it. I have a suggestion to maybe expand the contribution of your work. It's not going to be easy, but it's a relatively simple suggestion. So if you're a retail trader, you get pretty good, at least in my view, you get very good pricing for your trades. Wholesale gets paid. Everything looks good. Looks like a pretty straightforward equilibrium. I think the one thing that you may be missing in that equilibrium is what happens to the retail investors' funds that come in and out of the sweep account. So if you think about like TD Schwab and others, everything comes in and out of that sweep account. My understanding is that the rates and fees associated with those sweep accounts vary across the organization that you work with. And TD Schwab made some changes to what they did with the sweep account. So there's a sort of a side payment structure that's going on that may be worth looking at. Just a suggestion.
Okay, I did not know that. We'll take a look.
All right, thank you, Sunil. Who else has a question? I don't see any hands up, so
I'll just jump in and go ahead without raising my hand.
go for it.
So, Rob, I'm wondering if you have any thoughts on which is more severe, the type 1 error or the type 2 error? And maybe by way of motivation, when I read Yashar's paper, one takeaway I had from it is that wholesalers might look first for mid-quote liquidity. And if they don't find institutions wanting to trade at the mid-quote, then they might actually offer sub-penny improvement. So my prior is that the type 1 error is probably the more severe, but I'm just curious if you have any thoughts on that.
So at least in the introduction of the paper as it's written now, given that we're trying to figure out what do retail traders know, misclassifying child pieces of institutional trades is problematic, given that we know those tend to be predictive of where prices are going. So that's what would bother me. It's not the, and even the 3 and 10, you worry about what about if 3 of the 10 that's not being identified are 3 of the externalized trades, which probably have different market properties, right? So almost for sure, the externalized orders are coming in different market conditions than internalized orders. And one might think that maybe those might be more predictive of where the market's going. Right. And so the algorithm is missing that, but I think it's the false positives are the bigger problem, personally.
Okay, good question. Who else? I know we got questions and comments and stuff. I've seen them in the chat. I've seen comments.
So Greg says that I was wondering if Abel Noser had this, but that would be another way to get at the pension funds. And yeah, because you don't need the timestamps to be correct. You just need the prices, right? So I think you're right with that, Greg.
Yeah, that's right. It can be challenging to piece the orders together, but yeah, just digging around a lot of the executed prices, at least according to Able Moser, what they send to us is at these sub-penny executions.
For what it's worth, Rob, I've seen a ton, like enormous amounts of institutional child orders with non-midpoint sub-penny executions. Like it's so common.
You're the one guy that could write this paper with
Well,
your data.
You've written a very nice paper, so it's, you know.
Could you tell us a little bit more about the rules that lead to these institutional sub-penny prices? Like, is it undisplayed quoting at sub-penny increments, or is there some sort of VWAP? Like, what's going on there?
I think if Mehmet can answer on the data from, I believe it's a negotiation between the electronic liquidity provider, the operating and the investment bank dark pool, and the investment bank on that end. We have not asked the data provider what leads them to give sub-penny. My guess is they make some sort of commitment to interact with the order flow on the dark pool. And based on the paper I have with Mehmet and Hatch, and ours was not new, so Megveld and others kind of showed this way earlier. Ju's got a theoretical piece, but certainly there's a benefit to interacting with a small piece of a child order in a dark pool at the beginning, because you can trade on the back end. So maybe you're willing to commit to give some price improvement. So and then with regard to Copera, my guess is these brokers are competing once a year, every 6 months, to get a higher position on the league table with regard to routing. And one of the ways they're evaluated is through execution quality. So that's my answer. I don't have anything better for you.
Robert, I would
Actually,
almost really say that the data provider would tell you it's competition,
Yeah,
right? In order to get the order flow, I've got to give you a better price.
That's fair.
And so there's competition to get the order flow.
So
So every execution desk in an investment bank would have, these ELPs in the routing table. So you can go to Credit Suisse. They would have, Virtu, Getco as a place to route their orders to. So it's not specific to, to this investment bank.
Mao, you have a hand up. Would you like to go?
Yes. Bob, great paper. I want to have a big picture question. I want to know your general
I feel like
view.
Hold on, Mao. You've got like feedback. There's like coming out of a speaker or something.
Oh, really? Can you hear me better now?
Yeah, that's good. Perfect.
Okay. Yeah, Bob, it's like a very nice paper. I want to know your general view about the effort to identify retail trades from public available data. Because anyway, it's very hard to get retail trades from public available data. Which direction? It's should we find a better algorithm, or we should not do that at all? It's because it's so hard. It's
So certainly one thing we need to do is go down that path. And we'll go down that path in the spring. You tell me, do you think odd lots are a credible path? You can measure odd lots in the ADF, right? We have odd lots in the wholesale data. We can look at the correlation there and see how representative they are, recognizing that institutional trades trade against a one-share passive order and generate an odd lot trade. But just, you can imagine that being a path. You're aware of the paper in the options market that's trying hard to see if you can't find a measure of retail trading in the option market that might be better than what's being done in the equity market. That could be maybe fruitful. But I think this is, given that people are trying to say retail investors are doing X or Y and predicting X or Y, the possibility that it's institutional child trades doing that, I think, is problematic for that usage. Right?
Can I understand it's you also think using size information may help? That's probably one direction.
Well, that's one thing we're going to check.
Yeah.
So yeah, unfortunately, I had to teach a lot. So did a couple of my co-authors. And Jennings can only do so much. He's an emeriti, in case you didn't know. So
thank you.
Yeah, sure. You've got your hand up. Would you like to go ahead?
Sure. So thanks again for the paper, Bob. So what I think is the most relevant feature of the BJZZ algorithm is producing something that has this like highly variable imbalance. And what I'm curious about your findings, especially regarding the institutional child orders, is the following. So yes, there's going to be child orders, no question about that. The question is, if you have those falsely identified child orders as retail orders, and they cancel each other out, that's not going to have an implication for the imbalance in the measure, right? So my question is, to what extent the imbalance in the measure is driven by those child orders versus the actually correct?
That's a great idea. That's something we could do. We can at least do that for the big data set we got from them. We could start to go down that. That's a great idea.
I believe Hans has asked. I think that's the H in title H. When institutional traders try to mimic retail orders with their child orders?
So I guess, and this came up at Maryland last week also, it almost seems for sure that if you're an institutional investor, and you certainly one option for an institution is to place marketable orders with these zero commission brokers, yes? And you're executing at or within the spread. So we would, I think, argue that at least some of the stuff that we call, so again, we've learned a lot handling these data since May. Back in the old days when Bob and I had data from Knight Securities in 1999, if you looked at the realized spread for these marketable orders, it was the same as the market effective and realized spread over 5 minutes was the same. Well, hell, you look at the 605 data, and you know that's not true anymore. Now, commissions have come down, we have penny spreads, but also I think the clientele and this has the clientele of the different brokers is certainly different. So I would agree with what Hans says. And if you look at the execution quality paper by Schwartz et al., they find some execution quality differences across brokers that doesn't, if I remember right, necessarily correlate to order flow payments. And part of that could be that certain retail brokers have different clienteles that are more savvy than others, and that's being priced by the wholesalers. Anyway, I don't know if that answered your question, Hans. So
Okay.
I think in the Boehmer Jones paper, there's a bit of confusion between institutions being able to quote on sub pennies and being able to trade on sub pennies. And you cannot quote on sub pennies, but you can trade on any penny you want. And as soon as I read that in their paper, April or May, I called the data provider, one of the data providers, and just asked them. They go, no, of course we could, just to make sure, because I'm getting old.
Yeah. Do we have other questions? Oh, Amber has a question. You can go right ahead.
Thanks, Robert. Thanks for the paper and all the institutional details. I just had a question. Do you believe that institutions have like a TD Ameritrade on their wheel? I haven't seen that and that hasn't come up with the conversations with the institutional traders, but is that something you expect?
So if there's a spectrum of institutional traders, my guess is at the smaller end, some do, or maybe it's the RIAs that Sunil talked about. I don't. I just saw the big order sizes coming in and just started scanning for web pages, and so that I have no evidence on an institutional desk that's what's happening. But just looking at the marketing pitch and kind of the distribution of orders that were placed.
Okay, thanks.
Yasser, you got your hand up. Would you like to go ahead?
Yes, it's just something else about into my mind. So Bob, to what extent do you think the institutional like liquidity seeking behavior is satisfied through brokers versus the SDPs that wholesalers have? I mean, you have this other paper where with liquidity, like in electronic liquidity providers, where you show institutional orders that are exposed to those guys have higher execution costs.
So this
I'm
also
like what type of competition?
Yeah, so this came up at Maryland also. It seems like if you really wanted to kind of cloak and you wanted access to the liquidity provision, why wouldn't you have 4 or 5 different retail brokerage accounts and just periodically spray? And then you kind of, in the Kyle 85 sense, you're kind of cloaking with the uninformed, right? And you're coming through a pipe. So at least in the paper I've got with Mehmet and Brian, the ELPs know the pipe that the order's coming through, right? And so it's 1-to-1 almost, whereas here you're cloaking. And now presumably if things get, my guess is if this was, so if the market order paper has broad appeal and everybody reads it, go figure that. And everybody started pounding orders through, certainly the wholesalers would have to adjust their value proposition with the brokers at some point.
Anyone else?
Well,
Okay.
Thanks again. I mean, part of this is us.
Oh,
just-
here we have a
buyer
question from
beware.
Eric Kang.
Okay.
Eric, would you like to go ahead?
Hi, I just have a quick question about how you measure the order imbalance and the BJZZ algorithm, like how it signs trades, because I think in one of your earlier slides, you showed that the price improvement is actually often not de minimis. It actually looked like almost like 0.8 of a penny or something like that. And so when the bid-ask spread is larger than a penny, which it often is, especially for high price stocks, just using sort of the modulo, that to assign trades, I don't know if it makes sense, because if you, if the price improvement you're offering is 0.8 of a penny, I thought the BJZZ algorithm would say that to sell, but could be a buy or whatever. So I was just wondering how you compute it when you computed the sort of 0.3 correlation of, inferred order imbalance versus true. Like if there's some kind of fine tuning of the signing logic.
So kind of in the draft we'll post, which is again incomplete, it's preliminary. We have it, so certainly, so the algorithm does a great job of signing trades, except when the spread's wide and the price improvement is not de minimis. But even, and Bob can correct me, I think even like in the worst case bucket we look at, it's about a 96% success rate. So the inferred side of the order equals the actual side of the order. So when we compute the order imbalance numbers, we just use the inferred side. And then we compare it to what we know to be true, at least for the orders we have.
Yeah, you had a slide that would say what percent are misidentified sides. One of your slides, and it's not a huge number. Again, which is very different than the Schwartz et al. Wait, which author's first on that paper? I get a little confused here. Is it Schwartz or?
I don't remember.
Yeah, so they find more like 70-something%. But again, they only have 20% of their trades occurring in penny markets. We have 40-something% in penny markets. So we do a lot better on the side.
But certainly we've got one or more tables kind of in what we'll post, which will be either later today or tomorrow, so that you can kind of see.
To jump in very quickly about Eric's question. So if you did BJZZ to identify trades and then sign trades based on the actual MBBO at the time of transaction, or like a millisecond before that, whatever, the general results in BJZZ would be super robust, so they won't change.
Okay. If there's no further questions, I'll leave it open for just a little bit after, but I'll do the formal wrap up here because we're just about at the top of the hour. So please, everyone, thank Robert for coming along to do.
Thank you.
To present his papers, and thanks for the wonderful discussion, everyone. Have a lovely weekend, I guess. But if you have a couple questions, Robert will hang around. So, all right. Amber, would you like to go again?
Yeah, thanks. If I have one. Robert, do you know what the SDP codes look like? Can they be in subpennies?
I don't think they can. But we don't know.
They can't, as in by regulation, you don't think they can't?
I don't think they can. But that doesn't mean I can't have a negotiation that if you send, it can be the implicit quote is sub-penny, yes. You write me orders and I'll give you on average this much relative to the NBBO. I can ask the data
Yeah,
providers.
Okay.
Is probably the better answer.
Okay, thanks.
Anyone else?
I had a question. I was wondering to what sense you have what happens when the order gets externalized. It seems like kind of a black box, but I'm wondering how much you guys reserve for those orders.
So it is a black box in that data. I don't know how much they want us to look at that. So as we see the data, it says, Bob can help me here. It says
Street.
street. Put it in. So there's different fields. It says fully internalized, street, partially internalized.
Well, no, oh, no,
Is
on
that
that
right?
side, it's fully internalized, partially internalized, fully externalized. So the really big orders are partially internalized. So they source both internal and external liquidity for the biggest orders that they receive. But exactly where it goes when it's externalized has been hidden from us.
You guys have any guesses?
Well,
Yeah.
so I think a guess would be that maybe you try to find a place to execute it in the dark so you avoid the exchange fees and stuff like that. So certainly the liquidity provider, the data providers have made it clear they pay a substantial amount in fees to source exchange liquidity when they do that. I wouldn't be surprised if there's some laying off or trading amongst the wholesalers in the dark, but that's just speculation.
Could you
Yeah.
maybe even give us a sense like how much is mid quote, sub penny, or at the spread in terms of what's externalized?
I think, Bob, almost nothing, on average, it's outside the quote. And so I see what you're getting at. So certainly, Bob, I think
Yeah, I mean,
we could
I don't
identify
know
the
the
mid
answer.
quote, and that's almost for sure IEX is what you would say, Tom?
It could be, but it could also be any of the dark mid quote facilities, right?
That's true. That's true.
I don't know if I've ever run sub penny externalized.
We can do that.
I mean, I certainly on average, it's price disimproved, but I don't know.
Hmm.
It's not all price disimproved, obviously.
I was at the FRA conference this past weekend, and the Barber et al. Paper was on the program, and Chris Schwartz said that he talked to one of the wholesalers, one of the big ones, and they told him that, like, if Citadel doesn't, if they exhaust it, they might send it to Virtu, because maybe it's too much inventory on Citadel's book, but it's okay for Virtu, and vice versa. That kind of surprised me, but I don't know if that happens or not, but that was interesting.
We've heard similar things,
But yeah, I don't think that would surprise us.
Yeah, okay.
but there's no way. Yeah, it almost reminds you of the FX market, the interdealer trading market, stuff like that. But
Thanks, guys. It's a fun presentation.
Okay.
yeah, thank you.
Anyone else? All right.
See you, Bob.
All right, thanks, guys.
All right, let's wrap it here. Everyone have a lovely week for whatever's left of it. And yeah, remember the call for papers is on the 16th. All right. Goodbye, everyone.
Bye. Thanks again, guys.